Again, welcome to Chapter 3, Analysis of Financial Statements. And Chapter 3 is going to be a continuation of what we covered in the last class, which is covering an analysis of financial statements. In today's chapter, the analysis will focus on various performance measurements or performance analysis of these statements. Let's say, for example, like I was discussing with Robert about, the markets right now, or the comparison of companies. If you had to compare companies, how could you compare companies on their financial basis if one company is small and other company is large? And one way to do that would be to look at ratio analysis. Okay. So the topic for discussion today would be discussion of ratio analysis. We look at several ratio analysis based on their objective. The DuPont system, which is sort of an enhanced basic ratio analysis, and I think all of you would have covered this in your survey of principles class. Pretty straightforward. Effects of improving ratios, limitations of ratio analysis, and some of the qualitative factors. So, like other chapters, the beginning, aspect, as we discussed, how would the ratio analysis fit in the whole scenario of our discussion? That is determinants of the intrinsic value. Intrinsic value is the inherent or the objective value of any asset, and we're looking at the value, which is a factor of the free cash flow divided by 1 plus weighted average cost of capital. So if you look at this basic formula, it's simply stating what sort of free cash flows a company is generating and what is the cost of that generation, because weighted average cost of capital is what? Is the cost of the capital, debt and equity, the borrowing in terms of debt or equity, the ratio, how much does it cost the company? So basically, the cost of money that has company incurred and how much the company is able to get, return or value addition from that cost. So basically, this is this formula, a simple formula. And I mean, no rocket science. Obviously, weighted average cost of capital has an inverse relationship with value, and the free cash flow obviously has a direct relationship with the value of the company. The higher the free cash flow, higher is going to be the value of the company. Higher the weighted average cost of capital, lower is going to be the value of the company. And as we were discussing, tomorrow, if the Federal Reserve decides to hike the market interest rate or influence the hike of market interest rate, that's going to fit into this weighted average cost of capital, because now the borrowing cost will increase, and that will have a negative value on company's valuation, and that will impact company's stock price in the market. So I guess that fits in the pre-class discussion that we were having here. Overview. Ratio, we have all discussed what the ratios are and why they're important. They facilitate comparison of one company over time. If you had to compare financial performance of a company on any specific department or any specific area, you could compare the ratio through a process or a period of time. For example, if I had to compare performance of a student over the MBA terms, I could look at the GPA over semesters. That's a ratio analysis. If it's going up, that means the student's been performing well. If it's coming down, then we just have to see what's happening. Or you can compare one company versus other company, and this is a very important tool for traders or investors or managers of firms, banks, investment banks, and so forth. So a lot of ratio analysis is done in practical terms by practitioners in the market. Ratios are used by lenders to determine credit worthiness. For example, simple ratio of debt over equity will provide an indicator to lender whether to lend more money or not. If the debt to equity has reached a point of 100% or 1, that means the company has almost borrowed as much as its equity is, and anything more than that will probably be a risky process in case the company defaults. Stockholders to estimate future cash flows and risk. And we look at those ratios. Managers to identify areas of weakness and strength. If the ratio analysis looks weak in the area, that's a weakness. If it looks good, then it's a strength. For example, if the return on investment is increasing over various quarters, that is a strength. If weakness, for example, if the debt is increasing compared to equity, that is a sign of worry for lenders. So let's look at a example here, and we have income statement. It's a case study that we'll follow through the class today. We got 2 years comparison. One is 2010. Since it's an older edition textbook, I wanted to keep an older edition because, frankly speaking, the old and the new edition doesn't have too much of a difference except the price. So if you wanted to buy the new edition, the only thing would have been 2014 would have been here, and estimate would have been 2015. Everything else would have been the same. So let's assume that we are in year 2010, and these are the numbers for 2010. And 2011 is yet to happen or is happening, and these are the estimates for 2011. Okay, everyone understand that, students online? So we'll follow this example here. Income statement, obviously, we covered in the last class, starts with the sales number, which is the revenue. Then cost of goods sold are subtracted, other expenses are subtracted, depreciation is subtracted. Depreciation is an expense which the company does not pay to anyone. Rather, it retains the cash, right? For replacing or replenishment of the fixed assets which have to be replaced because of the wear and tear. So total operating costs are, in this case, 5,816,960, and so sales less total operating cost will give you EBIT. What is EBIT? Earnings before interest and taxes. Interest expense relates to interest what? It's an expense, so would it collect or pay? It's an interest expense, so a company would pay for any borrowings that the company has taken. So again, my recommendation would be to review the material that happens so that otherwise, as you proceed to the follow-up chapters, it's going to become more and more advanced. So EBIT, we have done EBT, which is earnings before taxes, is negative 158,560, and then taxes are 40%. So in this case, why is there a negative tax? Because it lost money, so it's a credit that the company is going to receive from the tax authorities. So this will reduce the the overall EBT negative loss to 95,136. Now, 2011 estimate looks much better for the company. Remember, this is an example from the previous chapter. So here, because of all the investment, all the expenses that the company made in 2010, it finally seems to be paying off because the sales are 7 million approximately. Cost of goods sold. Remember, cost of goods sold are going to be associated numbers. They will be a reflection of the cost to generate this revenue, $7,035,600. So this cost is associated with this cost, this revenue generation, and that's known as what in accounting terms? We have an accounting specialist here. It's called the matching principle, right? Yeah, so that's how it's followed. Other expenses seem to have come down in 2011. Depreciation is about the same. Total operating costs are about 6.5 million. Earnings before interest and taxes are in positive territory, 5 million approximately. I'm sorry, 502,640. Interest expense have come down, so it looks like the company has paid off debt because the interest expense has come down. EBT is 422,000 approximately. Taxes, now it's positive because companies made revenue, so taxes would have to be paid. And finally, net income is 253,584. So this is how you'll have to read these financial statements. And now let's move on to the next, which is the balance sheet. On the left-hand side, which are the assets. Assets are equal to liabilities plus shareholder equity. Okay. So cash, remember, balance sheet is organized in decreasing order of liquidity. Cash, short-term investment. These are short-term investments of the company or somebody else invested in the company. This is the company's investment, you're right. So the company has invested. Accounts receivables. What are accounts receivables? The company has made sales but haven't actually received money, or the money is in process of being paid. So this is written as an asset. Inventory, finished goods which are lying in warehouse to be shipped off. Total current assets are 1.9 million approximately in 2010. They've gone up to 2.6 million. Net fixed asset, 939,000 approximately in 2010, and 836,840. What does that indicate? It's gone down. This is an indication that the company may have sold off some of its fixed asset. So again, on the right hand side, liabilities and equity. Liabilities, accounts payable. What are accounts payable? The money that the company owes to its vendors and suppliers. Notes payable. What's notes payable? Bank notes, short-term notes, short-term loans which the company may have taken from the market to overcome shortages in its working capital. What is working capital? Current assets minus current liabilities, right? So working capital is the short-term capital that the company needs for day-to-day operations, utility payments, vendor payments, supply payments, or receivables. So that is important because short-term payments are done through the working capital. Accruals are sort of the escrow we had discussed in the last class. So total current liabilities are 1.3 million, and they have come down in 2011, which is again a good sign. Long-term debt. So you can see that the company has paid off almost half of its long-term debt. Common stock. What has happened? The company has decided to issue more common stocks and increase the equity base in the company. Retained earnings have increased, so perhaps the cash infusion in the company is coming through common stock, sale of common stock, and that has increased the retained earnings. Total equity has increased, and obviously the liability and equity are equal to assets as in the previous page. Other data which is given to us is the stock price. So this is given $6 in 2010, $12.17 in 2011. Number of shares, as you can see, have increased. Earnings per share have increased. So overall, it seems like a good situation for the company in 2011. Dividends per share is doubled. Book value per share is $791 versus $558. Lease payments are about the same, and tax rate obviously is the same. The book value has gone up because of your this one here, total equity. So the cash surplus and the equity on the book will relate to the book value. So on book, what's the company valued? So can the company, so first type of ratios that we'll look at would be liquidity ratios. That is, can the company meet its short-term obligations using the resources it currently has on hand? Why is liquidity ratio so important? Remember, I've been emphasizing on liquidity for companies in every class. It's that important. Sometimes, you just strategize on the long-term picture, but you miss out on the short-term. And several companies have fallen into the trap of missing out on the short-term obligations because vendors can take you to court. Short-term debt holders can take you to court and force the company to bankruptcy. And short-term obligations are as equally important as long-term obligations. So these are important to understand. The liquidity ratio, that is how liquid the company is. If the company had to be liquidated, or if company had to come up with cash immediately, how much of cash would the company be able to generate? So first one is the current ratio, which is current assets divided by current liabilities. So where would these numbers come from? I'll show you one or two, and then I'll expect that you have figured out where these numbers are going to come from. Where do you think these numbers are going to come from? Current assets and current liability. So current assets are for 2010, 1.9 million approximately, and for 2010 liability, current liability is 1.3 million approximately. Okay, so let's see. This is 2010, 2.6. So let me see. Okay, I think they've made a mistake here. You see the mistake they made? This is for 2011 estimate. So this is 2.6. And here they're trying to calculate for 2010. Okay, so these numbers would be correct for 2011. So you see here, 1,039,000. So there you go, 1040. So you can just make this change in your PowerPoint. This is for 2011, or if you want to take 2010, then take the 2010 numbers. Students online, did you see the error in the PowerPoint presentation? Yeah, they're rounding up the numbers, yes. So the numbers are being rounded up. It's 2680, so that's the rounded up number, 2680. And for liability, it's 1039800, so that 8 is rounded to 40. So it's 1040. This will be for 2011. This is a typo. If you want to calculate for 2010, then the numbers would be 1947. You know, because I'll round off to 7. 1947 divided by 1329. So this is 2.58. Again, in this case, higher the number, the better. Why is that? Because you want to have as much of current assets as possible compared to current liabilities. So higher the number, the better. You know, a rule of thumb critical point would be 1, because you don't want current liabilities to be more than your current assets. So if this were to go, let's say, below 1.0, then if you're a manager of this company, then you should be scrambling to get your current assets, increase. Quick ratio. One problem with current assets and current liability number is the inventory. Remember, inventory, even though they are finished goods, they are not been sold, and you have no guarantee that those goods will be sold. So if you wanted to really get the real picture, then you can look at the quick ratio, which is going to be current assets less inventory divided by current liabilities. And in this case, let's go back and look at the inventory. And in this case, the inventory number is 1,716,000. So again, this is going to be 11. So 1,716,000. So 2680 less 1716 divided by 140, that's equal to 0.93. And that's less than 1 now. So you should try and make it over 1. How can you do that? So let me test you. If you're a manager of this company, how could you improve the current asset line item? That's you were not going to whip your sales staff and say go out and sell more, but if you had to do it immediately, let's say in next 2 or 3 days. You can't do it in 2 or 3 days. How will you do that? Think outside the box. You have accounts receivable at 632,000. Call up your clients and say, hey, I'm ready to give you a 3% discount if you pay me cash now. So that will give you an immediate cash. That's what companies do. They have, normally if you look at bills of companies, they'll say from 0 to 30 days we'll give credit, and from 30 to 60 days we'll charge so much of interest, and so forth. Pardon? No, accounts receivables. Accounts receivables are the amount of money that your clients owe to you. So if you call up your clients and say, hey, I'm ready to give you some discount if you pay me cash now. So if let's say, for example, the client owes you $100,000, and you say, I'll give you a discount of 5%, pay me $95,000, and so that will give you ready cash. That may incentivize somebody to pay you fast. So comments on current ratio and quick ratio, and this is a comparison. For example, 2011 estimate 2.58, 1.46, 2.3, and 2.7. Quick ratio for numbers are 0.93, 0.5, 0.8, and 1. Expected to improve, but still below industry average. Liquidity position is weak because you have a comparison of industry. Yeah. This one I think is also going, so just to 10, 9, and 8. Oh, yes, this is for 11, yes. This is correct now. This is correct. You are confusing me. Yeah, this is correct now. So, this slide is incorrect. That's why you have to make changes 11. So for 2011 estimate is 2.58. It has definitely improved. Look the kind of improvement that's happened. Industry is 2.7 and quick ratio is 1. So it's not up to industry mark, but it's improved from previous year. If you are a lender for this company, would you feel comfortable lending more money? Probably yes, because they have improved, I mean, again, lenders will be different, so if I were analyst looking at this company, I would give them benefit of doubt given that they've improved. Next is asset management ratios, that is how efficiently does the firm use its assets, how much does the firm have tied up in assets for each dollar of sale. Why is this important? Why is this answer to this question important? How much does the firm have tied up in assets for each dollar of sales? And ultimately, it's the investors. Investors will shift their capital if they are getting a better return on the investment. So when we talk about asset management, how much of return does the company provide to its investors for the asset that it holds, the investment that is done in its assets? Is it really using up wisely or not? And that's the reason why several manufacturing companies have done what? They've sold up their manufacturing assets and they've moved overseas for either setting up manufacturing base overseas or they're outright getting manufacturing done by some other company. Like Apple does. Apple doesn't produce its own products. So let's look at inventory turnover ratio versus industry average. Inventory turnover is, how fast a company is able to make sales for its inventory. How many times is it able to turn over the inventory over the year? And that comes from sales divided by inventory. Sales is going to come from which financial statement? Income statement. That's the first line item. Inventory is going to come from the balance sheet. So let's go back. So for 2010, we have 5.8 million. For 2011, we have 7.0 something million. So let's see what number they have taken here. So it's for 2011, 7.036, and inventory we just did, it's 1,716, and it's 1.0. So in 2011, the company is able to turn over its sales, 4.1 times, the inventory 4.1 times. 2010 it was 4.5. In 2008 it was 4.8. and then industry average is 6.1. So inventory turnover is below industry average. So why do you see this? On average, other companies in the same industry group are able to turn over inventory 6.1 times every year. So they're moving really fast. In this case, they're only turning it 4.1 times. So it's slow. Firm might have old inventory or its control might be poor. No improvement is currently forecasted because of the drop down in number. You know, it's been dropping down every year. Can you relate to a practical product in the market to this situation? In cell phone industry, since cell phones are very popular items. Nokia could have been a good guess, and one product which was really popular once upon a time, BlackBerry, Research in Motion, they had a similar problem. What are the reasons that products don't sell in the market? I mean, they go out of flavor, or they can't compete with competition, or some other factors. You know, primarily sales are important. Pardon? They didn't want to follow what was being demanded by the consumers in the market. You know, so all of the manufacturers, they try to follow in line with Apple. LG, Samsung, Apple obviously, and other competitors. But BlackBerry, they wanted to retain their own design and their own, you know, with a sort of a mini keypad, and they wanted to keep their own operating system. They didn't want to change. So they paid the price. Exactly, Mertis, BlackBerry, they paid the price. And if you were a manager of a company, let's say, and you wanted to improve your inventory turnover, what would you do in this situation? Make offers, and what would those be? You're right, your answer is right, but what do we call that in the market? Discount clearance, right? Year-end clearances for automobiles are really, you know, very popular. When new models are being introduced the next year, dealers will give massive discounts or good discounts on old models to move inventory. So in this case, if you are the manager, probably you might consider selling off inventory at a discount. Maybe it's old model. Maybe they are not coming up with new models, or what's being currently demanded by consumers. DSO, which is, you know, average number of days from sales until cash received. Again, it's important. It's receivables divided by average sales per day. And the receivables are going to come from your accounts receivables, that's the number, 878. So if you have a PowerPoint, make notes on these, because you know you might forget where the numbers are coming from. This is going to come from the asset side of the balance sheet. Sales is going to come from the income statement, the starting point, divided by 365, because those are the number of days in a year. So that is 45.5 days. In this case, would a high number be better or a low number be better? A low number would be better. You want to have average number of days from sales until cash received to be as low as possible. So firm collects too slowly, and the situation is getting worse. It may be because of poor credit policy. So you can see that over the years, the number of days until cash is collected is increasing. Industry average is 32. So again, company manager may decide to give some additional discount, you know, or say, hey, if you pay us cash, we'll give you maybe 2% off on your payment. Or nowadays, companies have started doing what? They've started financing their own products directly to customers. GE did that, and which famous company is going to start doing it? Apple is going to start doing it for their new phone. They will start financing their phone directly to customers. So they will try to cut down the cash flow, because earlier, they will still sell their phones to wireless vendors, but if they are selling it directly to customer, then their days until cash is received will be reduced even further, because they will finance, and once the sale is made, cash comes to Apple directly. Otherwise, they would have to sell to AT&T. AT&T will make a sale, and then maybe AT&T will take 30 days or 40 days to pay back to Apple. Now they can use those interest that they were probably going to be paying for those extra 30-40 days to sell directly to the buyer, because obviously they will sell millions and millions of cell phones. So this is another revenue generation opportunity for Apple. I think they're going to start September 23rd. For the new model is going to be September. No, the carriers are still willing to do that, but Apple sees this as an opportunity to go out and sell directly as a sales competitor, because earlier the model was AT&T was its exclusive, supplier, and Apple got a percentage in the service. So now the model has changed because of competition. AT&T doesn't pay a share of service to Apple. It just gives them a fixed cost of the unit, but it's not going to pay immediately. It's going to take 30-40 days. So Apple has to continue 30-40 days sort of a credit, and that is interest for the money that they will be offering, for the device. So here Apple could sell directly and cut away the interest. Or if the interest component can be reduced, because it still will have to pay to the financing company, or if it's own finance, then all the money that is going to be taken to be offered. But the idea is for Apple to get more revenue. This is another revenue generation model. That is for all models of Apple. We all say that next model will not sell as much, but they end up selling even much better than the previous model. So, and that's because of the new things that they add. They keep adding new things to it. So it's something that Apple buyers look forward to. So let's see what's going to happen. But the changes they made in last couple of iterations have been very subtle. It's not very drastic change, but let's see what's going to happen. Fixed asset and total asset turnover. This is looking at how well the fixed assets are being used in respect to the sales. So net fixed asset is going to come from asset side of the balance sheet, and the sales is going to come from the income statement. So sales, we already know, is 7036. Net fixed asset, we can go back and see. Yeah, this is the one. 836 rounded off. There you go. So it's 8.41. that is the investment in net fixed asset is being utilized 8.41 times, to generate those sales. Will a higher number be better or a lower number be better? A higher number would be better, because you would want to have as much of sales as possible compared to your net fixed asset. Okay, so again, a higher number would be better in this case. Total asset turnover, sales divided by total assets. And this again, we'll just take total assets from the balance sheet, and this is 2. Again, higher number would be better. As high as possible would be better. So again, when you are a manager and your shareholders are demanding higher and higher profit and higher and higher utilization of assets and investment, what would your first reaction be to keep your board of directors happy and get as much of bonus as possible in terms of net fixed asset? Sell off your manufacturing facility and move to another country for manufacturing. Contract manufacturing, that's what companies are doing. Is it ethical? That I'm not going to answer that, but I'm just going to show you what managers have been doing. I mean, when you saw this trend of companies selling off their manufacturing facilities and moving abroad, it's easy, because the time you reduce your net fixed asset, what's going to happen? The fixed asset turnover ratio is going to go up, and that would look good on books. So one lesson is ratios can be deceiving. They look nice on paper, but if you are an analyst, you have to look deeper to understand what's really going on. I mean, let's say, for example, if the company had 1.4 as fixed asset turnover in 1 year, and then suddenly next year it has 3, you shouldn't really get excited, but try and find out what has gone. I mean, has the company sold off its manufacturing facility and moved to another country? If that's the case, that's fine. I mean, that's a strategic move, that's fine. But how well? How does it meet the requirement? For example, if Apple decided to sell off its manufacturing facility in US and move to a contract manufacturing in China, how well strategically would that be sufficient to supply millions of handsets, when the company announces its next iteration of phone? Will that contract manufacturing facility be able to supply quality phones as Apple is known to be? So those things have to be looked into. Just because Apple sold off its manufacturing and went over to China, maybe the products come back with poor quality design and battery and other products, and that will be a negative impact. Because consumers, the first thing they'll look at the phone and say, hey, the made in US phone was much better than the made in China phone, so I'm not going to buy this phone anymore. So those kind of things have to be looked into when you are trying to tweak these numbers. But on the other hand, if you get paid $10 million bonus, I mean, that could be a lucrative end result. So you can see why managers fall into the trap to take the easy way out. And that's where we talked about the agency theory. So fixed asset turnover is expected to exceed industry average. So industry average is 7. It's expected to exceed, which is good. It had gone down in 2010, but it's going to increase back in 2011. Turnover, total asset turnover, not up to industry average, which is 2.5. Caused by excessive current assets. So again, the culprit here seems to be inventory. There's a lot of inventory which is lying up in the company's warehouse. So one thing that the manager should look at is to try and get rid of inventory, even if it means a little bit of discount. because that will free up inventory, improve the total asset turnover. It'll also improve other ratios we had discussed. It'll improve the current ratios as well. And then strategically, company should improve its design or whatever it's producing. And this again, if I think I should bring this again, why do you think Apple comes up with a new product every 6 or 8 months? Maintain a leadership position in the industry and not to come in a position where it's lining up huge inventory, right? Because if it's going to come with a new product, there's going to be demand for it. If it had the same iPhone from 2014 or 13, after a while, consumers will start getting, bored, and they'll just say, yes, exactly. They don't want to be in a situation where they have to discount their phone, because they want to show that their phones are in demand and it's selling at the retail price. There are companies like premium car manufacturers like Ferrari, which does only maybe 2,000 cars in one model series, and they're booked 5 to 7 years in advance, paid cash down. So you can imagine the company having, hundreds of millions of dollars paid in advance for a delivery which is going to happen 5 years from now. And why is that? Again, they create a demand for the product. On the other hand, you have companies like Toyota, Nissan, GM, Ford, which mass produce, and they end up with inventory, and they change the model, and then they have to sell at a discount, obviously, when the year-end models, sales go up. So it also depends on what product you are manufacturing and what your strategic goals are. Toyota and all the other companies that are mentioned, their strategic goal is to sell as many units as possible, because their goal is to mass produce and make revenue on volume, keeping a very competitive pricing strategy with other companies. Ferrari, for example, it's a unique product. Nobody else makes a product like that. So they can command the premium as they want because there's a market demand for the product. Apple is the same thing. They try to create that market demand. So debt management ratios, does the company have too much of debt? Can the company's earnings meet its debt servicing requirement? Again, important. By the way, that's a topic for term paper, For those of you who are still struggling to find a term paper topic, that's a term paper topic. How companies are able to generate a demand for the product, and how does it reflect into financial profitability for those firms. So to calculate the debt, total interest earned, TIE is total interest earned, and EBITDA, it's pronounced EBITDA, it's EBITDA, which is depreciation and amortization, coverage ratio. So the debt ratio is total liabilities divided by total assets. It's a straight, ratio analysis. So total liabilities is going to be 1040 plus 500, which is going to be from the balance sheet on the right-hand side. So let me clear this. Remember, total liability will not include other items. You'll only include your total current liability plus the long-term debt. That will make your total total liability. Why won't you add common stock to it? Company owes that money to its shareholders. Why don't you add common stock to liability? That's a trick question. It's not a liability, it's the shareholders' wealth in the, it basically is the investment of the shareholders. So exactly. So it is your investment in the company. Okay, and the total assets are obviously going to come from the asset side. So let's go back. There you go. So it's 1040 plus 500 divided by 3517, which is 43.8%. If it's less than 50%, I would be fine, you know, as long as liabilities are less than total assets. But we have to still see if it's comparable to industry average. EBIT divided by interest expense. Now, why would TIE be an important ratio? TIE is total interest expense in this case. Times interest earned. Times interest earned. This is times interest earned, TIE. So why would that be important? There are like 100 ratios, and have to memorize all the acronyms. That's times interest earned. You right there. I mean, how many times do you have cash or sort of available source to pay the interest? So interest is something that you would have to pay. It's a contractual obligation. And the higher the TIA number, the better, because you want to have as much of revenue available to you after, you know, expenses to cover the interest payment that you have to make. The higher the number, the better. So 502.6 EBIT is going to come from income statement. Interest expense, there you go. So you got the EBIT number 502 and interest expense here 80. So if you have a ratio of 6, you are covered quite well to pay the interest. There is right now no immediate threat that the your bondholders would take you to court, because you can easily cover the interest payment right now. You're earning about 6.3 times. Obviously, higher the number, the better. EBITDA coverage. Red line number, here you go. Industry, but don't take the red line number industry as the total industry. This is an example industry. Like, for example, if this is a software company, this is the peer industry, group, which is 6.2, just a comparison number. But let's say if you are an analyst and you're looking at 6.3, you would be a little satisfied to say, yeah, a company is not going to go to bankruptcy because of non-payment of interest in this case. But if, let's say, the TIE number were 1.5, that's a really low number. I mean, it's really close to that earning potential to cover the interest payment, because there'll be other expenses also. So let's look at EBITDA coverage. Earnings before interest and taxes, depreciation and amortization, plus lease payments divided by interest expense divided by, plus lease payments plus loan payment. Now, from our available information, we are not given any loan payment information, so that's 0. We are given EBIT, which from the previous slide, that's 502.6. Depreciation and amortization we can get from the income statement. and also we can get it from our lease payment. Here, this is the lease payment, and this is the EBIT, and this is the depreciation. So EBIT, depreciation, and the lease payment, 40,000 has been marked as 40. Interest expense we already know is 80. Lease payment we already know is 40. So remember, lease payment is coming from other information. This is from other information given. If you are looking for where you got this number from, this is other information. And this is from your income statement, income statement, income statement. Oh no, this is other information, lease payment. So this is 5.5, again a refinement, but nevertheless seems a decent number. Let's see the comparison. Debt to asset. Company is actually better than industry because industry is 50-50. Times interest earned, it's better than industry. And the EBITDA coverage is lower than industry. So recapitalization improved situation, but lease payment dragged down EC, which is EBITDA coverage. The next one are profitability ratios, which are sales and assets. So return of sales and return on assets. And the first one is the net profit margin, which is net income divided by sales. In this case, the net income, where is the net income going to come from? Income statement. So this is going to be income statement, and I can show you. That's the net income. And sales is going to be from income statement as well. So this is 3.6%. So your net income is 3.6% of sales. How would you look at this number as an investor? I mean, I'm not asking you to analyze. Higher the better, yes, but how would you really, if you are an investor in this company, how would you view this number? Or what your thoughts would be in terms of selecting a project for investment? Pardon? Exactly. For example, if you are an investor and you have a choice of 3 different companies in same sector or different sector, you probably are looking at this ratio and seeing what percentage of sales is being realized as net income. What is the profit margin? This probably seems like a very competitive product where the sales margin is just 3.6%. Again, we go back to discussion of Apple. I mean, I'm keeping that as a consistent discussion. Apple, because of its innovation, is able to generate a very high profit, the sales margin, the income margin on sales. So again, innovation, product differentiation, that leads to higher profit margins. And that goes to the discussion on the price equity ratio. Price at which a company stock is selling divided by price earning. Earning is the amount of earnings per share. So in some companies you have this high ratio and some low. Even though investors would say 20 is a benchmark number of price earnings, you really think that would be a reflective of company's performance in future? I mean, let me show you a very quick demo. What is price earning ratio? Exactly. Students online, just give me a second to share this website. Okay, students online, can you view the browser window that I'm sharing? Let's take Microsoft. So I want you to concentrate on this number. The price earnings for Microsoft is $29.72. I'm times. So this is the Microsoft stock is selling 29.72 times its earning potential. So for every dollar that the company generates, the stock is selling at 29 times. Why is it selling at 29 times its earning potential? The market is expecting Microsoft to deliver in future this extra premium that the investors are paying right now. So let's look at another company. Apple is selling at 13.45 times its earning potential. That's a surprise. Really, that's a surprise. I was expecting it to be. It's selling at quite a bargain right now. It's selling at quite a bargain. I mean, really, this is a surprise. I would go down and buy some of Apple immediately. Yeah, this is at a. I'm really. I haven't caught up on its pricing, but this is 13.45. So this is a reflection that the market is ready to pay a premium for Microsoft stock more than Apple stock, because Apple pays $8.65 dividend, and its stock is selling at 13.45 times its dividend paying, potential or price. So that's an eye opener. So what is that reflection of? 13.45 times. What is the reflection? Yes, people are probably betting that Apple may not be able to keep up with those revenues. This is what this little ratio is telling, that overall the market is saying Apple may not be able to keep up with those kind of revenues that it had made in past. Versus Microsoft, yes, because this is a ratio analysis. And the fact that Apple is coming up with its own self-financing scheme could be one way to get the entire profitability up again to a level. Yes. The dividend here is 2.08, right? and this is 8.65, which is earnings per share. So how do you calculate PE ratio? Which price? So 116.28 divided by 8.65 will give you 13.45, right? So earnings per share is free and clear free cash flow per share. Dividend is how much the company shared with its stockholders, and 116 is the price the company is trading at. And when you do PE ratio, it is 116.28 divided by 8.65. So Apple stock is trading at 13.45 times its earning potential. Is it the number? Let's look at Ford. 15.45. It's trading higher than Apple. I'm surprised. Microsoft trading at 29.72 times its earning potential. I don't know if maybe Microsoft is expecting a higher than, you know, average sales from its Windows 10 operating system. And it's also raised the dividends 16% to 36 cents. It's increased its in quarterly, dividend, and it's bought some other companies. Okay, let's see. Why? Because earnings per share is a negative number, so it's not, it can't be reported, and no, it just means that in the last quarter it didn't make positive net income. So Google has 29. Facebook, look at Facebook. 94.41. I mean, I don't know what to say. Somebody knows more about Facebook than probably I do, or I mean, obviously I don't claim to know everything about Facebook, but that's true. I mean, here's the issue. One thing is technology is very hard to value. Unlike, core industrials where you can value by units sold. It's very hard to value technology. For example, what is the value of Facebook? Because the intrinsic value is going to be quite different, between different people. For example, if you ask me, what is the value of this building? 9 out of 10 people will fall into the same ballpark range. But when you start valuing technology, I may say, hey, this technology is going to be super hit in next 5 years. You may not agree with me. Even biotechnology is very hard to value, but you have some benchmark to compare its valuation by the drugs which pass through the various FDA approval stages. The more stages it's cleared, more chances it is that the drug will make to the market. And that increases the value of the biotech company. Let me show you a very famous example. I had always assumed that Apple would have been over 25. It does not reflect the kind of products that Apple is selling in the market. Something is going wrong. Something is which I'll have to read and see what's really the fact. Why is Apple stock not reflective of the earning potential? Then why is market not really giving it its due? But that shouldn't really impact the stock price, because it's we talked about the free cash flow that the company has. It is the equity of the owners. With a what? It's hard to say about, let's see how things progress. It'll be a good exercise for us to review during the semester, looking at all these stocks and seeing how the PE ratios are changing. The launch of its new phone is not too far away. Let's review that. Once the phone is launched, would that change the exercise? I want to also share, this example. Yeah. So that, obviously, if the sales numbers are good, it will have an impact. So let's see how that does. I want to share with you, this company, Dendreon Corporation, which I've been following this stock for God knows 8-7 years. Biotech company. It had some products which were going through the stages of the FDA approval, and it just jumped the day announcement came that its drug had passed FDA clearance and the product could be launched in the market. So like the spike you see here, from this is what price? This is $40. So it spiked almost from $13 or $14 to $40 overnight. And news is everything. The moment you place an order, and if you catch on the right side of the order, you can obviously make money. I made some money just the moment the deal was announced. I had orders ready to go through. It went through, and immediately when it was okayed, I sold off. And I'm glad I sold off, because look at what happened. Look at what happened here. So news is everything in the market. Look at, this is $40. It came down to what? $10. Because in the follow-up trials, it came out that the drug didn't meet the standard, so it had to be pulled off from the shelves. So look at the market. Look at the market capitalization. From almost $40, and the volume is 20 million stocks, it dropped to $10, so $30 per share loss, and we're talking about volume of 55 million shares. So 55 million multiplied with $30, that's close to 1.5 billion lost in one day. So all these ratio analysis, are that's the reason why these ratio analysis are so critical. If you do not follow, if you are investing and do not follow, it can, impact on the negative side. So let's just continue. And I'm really surprised. I would say Apple is a bargain right now. Though I would not hold it like an official comment. It's just informal. But don't place any bets on this thing. And because tomorrow if you lose money, you're going to come and catch me. So, but I trust Apple as a company. So they seem to take care of their investors. So we did this, right? Okay, let's move on. So gross profit margin, which is sales minus cost of goods sold divided by sales, and that's 17.6%. Now, 17.6% gross profit margin. Again, these numbers, one thing that I obviously wanted to discuss was the price-earning ratio, and that is how investors view where they want to place their money. So these ratios would be in the same light and context. For example, are you comfortable with a gross profit margin of 17.6% on your investment? And that's what investors really look at. I mean, in terms of certain business cycles, this may be a good number. Then in certain business cycles, this may not be such a good number. You may want to reevaluate your portfolio. So again, comparison makes it easier for us to understand. Profit margin 3.6, which is right at the level of industry. So this is good. Operating margin 7.1, which is same as industry, which is good. Gross profit margin is 17.6, better than industry. So it's expected to exceed industry average in 2011. So what's that going to do to its stock price? It'll help the stock price, as we had discussed, that investors might view this as a positive number. And that's the reason why whenever publicly listed companies announce their financial statements, how many times do companies announce their financial statements? Publicly. They have to, by law, announce quarterly. And those are the most eagerly awaited announcements. Because if they beat expectations of industry, what happens to the stock price? It'll immediately go up. If it doesn't meet industry average, the analyst expectations, the stock price will drop. And where do you get that information from? Analyst expectations. Which one would be a most common and easy source to get? You can just go to government site will not give you analyst expectations, but you can go to Yahoo Financials. Yeah. So for example, Microsoft, and let me just narrow this down a little bit. So if you go to analyst opinion, so it gives you a weekly recommendation. The mean target is the price reflective of the stock price. Median target. What's the difference between mean and median? Median is? But what is median reflective of? Average is, mean is average, median is the middlemost entry. Okay? So median is a little bit on the positive side. So what does that indicate? More investors are on the negatives, I mean on the short side of it. High target, somebody's really valuing Microsoft quite a bit, 60. Low target is 37. Number of brokers 29. So it's analyst opinion, what the market is expecting, and you can see different analysts are providing their action, which is upgrade, initiated, downgrade. So you can see, and then there's average numbers also given. So this is a good basis to make any estimates about a company if you are looking at investing in a company. And then you can also look at analyst estimates, which are going up to June 2017. Now, how are they able to come up with a number which is going to happen sometime, 2 years from now? Yeah, they do plan, but what are they looking at? Do they have like a magic lamp that they hide? And yeah, they go through these ratios exactly. They go through exactly the same ratio that we are covering, but they also look at future factory orders. Those are to be released. I mean, they're released by companies, or I've heard funny stories where they will call up the inside sources in factories in China and say, hey, what are you producing right now? And what sort of numbers are you producing? And does this new laptop of Dell, does it have some new features, or does this Apple phone have some additional features? And while iPhone 6s is going to be introduced in the market in September, they're probably already working on iPhone 7 in their labs in California. Windows 10 has been released now, but Microsoft may already be working on Windows 11 and 12. So they work on 3-year cycle. Every three years they have to come up with a new product. Yeah, they will. If you go through the documentaries that I designed, I mean, you'll see how they have the insider. I mean, even though insider information is illegal, but they look at factory orders. Just looking at the legal side of it, they look at factory orders, because companies, for example, if Apple has placed orders of 10 million iPhone 6 Plus to the contract factory in China, so you can calculate. You can. Even though we are discussing right now, there'll be tens of websites which will already be estimating the cost of iPhone 6. Let's see. It's very interesting. There you go. iPhone 6 Plus teardown. So, this site has already given an estimate of what the cost of phone should be. They probably look at this. They have a comparison of different phones. So for example, $51 is for display, $6 for battery. Yeah, so they've already estimated. I mean, if you are working day in and night into the industry, for example, if I'm working in manufacturing or cell phone industry, I can estimate if there's a new feature, how much additional cost it will take to manufacture that. So you can see that, for example, if Apple's total cost of operation of this phone is $242.50 for one phone, that's their cost. And if they sell it at $700 a piece, so they will make a profit margin of about $450 per phone. Even if I take off $50 for marketing and shipping and other things, they're clearly making $400 per phone. And $400 per phone, and if they sell 1,500,000 phones, it's not rocket science to estimate how much money they'll make. in next quarter. So this is how these estimates are worked out. And it's basically, look at this, they've already opened up the phone and they know exactly what's gone in the phone. So where are the pictures coming from? Is Apple supplying these pictures? No, they have the industry sources who are probably giving them this information. Look at this, the circuit board pictures are there. And how much time did it take for me to search this site? I mean, I just searched on Google and there it came. And they have given, even the capacitors and the processors, what's going to be used. They've even given the company names. Exactly. So look at this. They have even given, the breakdown. Okay, students online, any questions so far? So it's going to be all this analysis that will go into the total analysis, but at the heart of it is just simple ratio. So for example, you have a similar breakdown of a Samsung, Galaxy Edge, or they have their phone. So you can look at, as an investor, which company is providing a higher profit margin. So you can find if Samsung has orders for those many number of phones versus Apple has those orders for those many number of phones, which company is going to provide a better return on investment. Okay. Basic earning power, BEP, is EBIT divided by total assets, and that's 14.3%. In this case, we've already identified where these numbers come from, so won't have to go back. Basic earning power versus industry average, BEP removes effect of taxes and financial leverage. Useful for comparison, projected to be below average, room for improvement. And again, practical sense, how do companies try to improve their BEP numbers? Where they try to remove the effect of taxes and financial leverage. A lot of companies are doing what? They are sheltering their earnings abroad and not bringing it back to the US, right? Apple has over $200 billion of earnings outside the US, which they are not bringing it back, because the moment they bring it back, it'll be taxed. And Apple is not the only one. Do you know the total amount of money which companies have kept abroad? The US companies? Yes. And they are not bringing it back? Over $11 trillion. We're talking about McDonald's, Coca-Cola, Apple, Microsoft. All companies, I mean, they have kept money abroad. Yeah, to give them incentive to bring it back, lower down that bring back sort of. But it's a lot of money. I mean, $11 trillion. You can, for that amount, you can buy a small country. Well, I think anything over $1 billion is the same. I don't know, if I had $1 billion and if I had $50 billion, I don't know what to do with the extra money. I mean, that's what Bill Gates is doing. He's distributing it back. But he said that he's not going to leave them anything except their college he'll cover the college fund and he'll cover probably some money, but he will not leave billions of dollars to his children. That's what he said. Yeah, Buffett has pledged all his earning to Bill Gates Foundation. Mark Zuckerberg, the Facebook founder, he says he doesn't want to join. He wants to keep all the money. So, okay, return on asset and return on equity. Return on asset is net income divided by total assets, and net income is 253.6 divided by total assets. You've already identified these numbers. It's 7.2%. What that is reflective of is how well the assets are being utilized, to generate net income. Obviously, higher the number, the better. Return on equity is going to be equal to net income divided by common equity. So shareholders want to understand, how well their investment is being utilized. And common equity is going to come from balance sheet on the right-hand side. Liabilities plus owner's equity. Common equity will be, it'll be total equity, yes. Yes, it'll be total equity, yes. And that's 12.8%. Again, this is important for investors because why do companies shut down perfectly? Some products which are perfectly well made, they are decently selling in the market, but companies decide to shut down manufacturing those products. Like GM decided to shut off, Pontiac brand. It was quite, it was decently selling. It was popular, but not that much. But it decided to shut it off. Hummer, another brand which it decided to shut off. The reason is looking at these ratios. What brand line is providing more return on equity, and if it's consistently losing money or consistently not performing well as the other units, shareholders may ask the board to, not keep putting resources on those brand lines, brand items, and move to items which are generating more revenue. So those shifts always happen in the company. Yes, yes. Exactly. They probably are not providing, as much of return on equity, or they may be loss making, branch companies. Yes, yes, they'll do that. For example, Ford, and it's a very good case study. Ford was the owner for Land Rover Jaguar. Yeah, Ford owned these brands in early 2000, but they were not able to generate profit from those branch items. So they sold off to an Indian company which made the cheapest car. Have you seen a car worth $2,000? They made a car worth $2,000. Have you seen that car? Let me show you that car. So the company turned around the Ford, the Land Rover Jaguar brand, and now it's a profit-making venture. So these kind of sales do happen between companies. Nokia sold off its hardware division. Nokia didn't sell off its company. It sold off the hardware manufacturing company to Microsoft, which manufactured mobile phones. They still kept, the software and the other design aspect of it, like Palm did. I don't know if you remember, there was a company called Palm which made those PDAs, Palm Pilots. They were popular. So they sold off the hardware part to some company, but they retained the software part. Eventually that died off, but let me show you. This is a funny car, but it's really cheap, So this is a car. Look at this. It's a decent car, and with the appreciating dollar, now it'll be even cheaper in the U.S. market if it were imported. But unfortunately, it won't meet the safety standards of the road requirements. But it could be used for, private, like resort and those kind of things. It was launched at a price tag of $1,500, and so the company that launched it, Tata Motors, they bought off Jaguar Land Rover from Jaguar Land Rover they bought from Ford, and they turned around the company, and obviously the company overall has been performing well. Look at the revenues, and it's still a British company. I mean, it's British company in the sense that they still have their headquarters in Britain, but it's owned by an Indian company, and obviously their sales and operations are all over the world. But this is the beauty of how corporates operate these days is brands are not something which is seen as a line item which can be sold off. I mean, it doesn't have a life. For example, it can be sold off. It's treated as an asset of a company which can be sold off to another company to generate revenue. Another famous example, because I followed that, was when the original Xbox was launched. They introduced it with a very popular game, Halo. Right? They came with 4 iterations of the game, 1, 2, 3, 4, and then Microsoft. It was a company owned by Microsoft, but after the 4th iteration, Microsoft sold off that company. Even though it was a perfectly, good revenue generation company, it sold off because Microsoft thought it'll be better to sell off and recoup any profits, and that's a spin-off. Companies spin off smaller companies all the time. What recent examples? For example, Microsoft, keeps buying small companies, and that could be one reason why its share prices have gone up, because now they may be able to use all those smaller companies to generate profits in future. So think about all these. The reason I'm going a little bit beyond finances to think about these ideas when you discuss about strategic management issues, which Dr. Marshall will teach you. He's going to cover some of the core areas why companies act in a way in terms of brand placing and disposing of brands or selling of items is for a strategic reason. Yeah, a recent example is Motorola. Motorola, they sold off, their cell phone and their mobile unit to Lenovo. IBM did the same thing. IBM, they sold off their computer manufacturing, the laptop, desktop, servers. I think they kept servers and they sold off the desktop and laptop to Lenovo, the Chinese company. Compaq sold to, Compaq was a merger, so they had the entire company. But IBM retained, the the customers, the strategic analysis and the database side of IBM with itself, the software part of it with itself. They only sold the hardware side. I mean, that's unthinkable to somebody, who probably is following IBM from the 1960s when IBM was a leader in laptop or desktop manufacturing. And if you tell someone, hey, IBM has sold off its laptop and desktop manufacturing to a Chinese company, you would think that's unthinkable. But in business, that's a strategic move. Again, looking at ROA and ROE, because if the hardware part of IBM manufacturing would have been loss-making, it would have meant that it wasn't wise to continue. And I can demonstrate that. Let's see. I think this happened way back. Let's look at the stock price, historic stock price of IBM. All right, students online, can you view the browser window? Okay, this is IBM. I hope it has enough data points. All right, so another information I want to find out is when did that exactly happen? So it happened sometime in September 2000. This is updated. It had to be longer than that. I mean, they didn't buy it last year. Ten years later, so it was in 2005. 10 years later, looking back at IBM Lenovo PC deal, so if it's 2014, it had to be sometime in 2005. So let's go back to that chart and look at what's happening in 2000. Look at the share price of IBM around 1993 and so forth. It wasn't really faring that well. I mean, it was doing some business, yes, and it was probably making some money, but it went up all the way to 100, and then it kind of collapsed down somewhere around here. So as and when the news of the share of the sale happened, look at how the price of Microsoft share had gone up. Obviously, this came down because of the financial crisis, but over the years, look at the amount of wealth that's been created for IBM after the sale of its PC and laptop division. It's almost 3 times. So the strategic decision of board of IBM to sell off their hardware division has been in the interest of shareholders. No, just the hardware. There's PC, laptop, I think, and some sort of enterprise, but not servers. But now they're saying that they also want to buy the server, because IBM has now shifted into totally customer, providing software-based solutions for customer and business enterprises. That's where their key profits are now these days. So you see that HP still Tech's 3rd largest employer, even though it doesn't manufacture any computers. it's still technology's third largest employer. So it's still a very important company. Price earning ratio 12.98. Again, I view IBM as an underrated company. It's a very good company, and it's very underrated. Some of the best brains in the industry, they work for IBM. That is known for. So we've done this. Let's move on. ROA is lowered by debt. Interest expense lowers net income, which also lowers the ROA. However, the use of debt lowers equity, and if equity is lowered more, then net income ROE would increase. So it's a decision of the management. Now, looking at the market value ratios. Market value ratios incorporate the high current levels of earning and cash flow, increase market value ratios. High expected growth in earnings and cash flow increase market value ratios. We have discussed these 2 points, that any cash flow current level increase, that is of earning and cash flow, would increase the market level ratio, and the high expected growth in earnings and cash flow would increase market value ratio. We've discussed that. High risk of expected growth in earnings and cash flow decreases market value ratio. Why is that? Again, just relate to this simple formula. So the free cash flow are this current levels of earnings. Cash flow is also coming from the free cash flow. Expectation would be in the next period. If FCFs in the next period are expected to go up, obviously the present value, the value of the company will go up. Any risks to the company, which is the denominator here, if it goes up, then the present value will go down because of the inverse relationship. Is that clear, students online? So let's calculate and appraise the price earning, price cash flow, and market to book ratios. Let's assume that the stock price is at 12.17. Earnings per stock is net income divided by shares outstanding. Net income is available from the income statement. Shares outstanding will be available from other data. What is shares outstanding? Number of shares outstanding means number of shares in the market. There you go. Here, shares outstanding. So that's equal to $1.1 earnings per share. Price earning will be price per share, which is 12.17, divided by earnings per share, which is 1.1. So 12.17 divided by 1.1 is 12. So this company stock is trading at 12 times its earning potential. That's how you will relate it. Is higher the number better or lower the number better? I think Robert answered it once. Okay, what was your answer? Is higher the number better or lower the number better in PE ratio? Again, that's an incomplete answer. It's from whose perspective you are asking. If I'm the buyer, it's not good for me. You'd like to buy it at bargain. You want to buy it at a low number, right? If you are a shareholder, higher the number would be better. Yes. Stakeholder, but you'd be careful taking at stake, because stakeholders include a lot of people. You would say as an investor, because you may be a banker to the company, and if you're a banker to the company, lower number wouldn't be good. Why? Because you, I would gladly lend money to Microsoft today. Lower, yeah, but first of all, as a banker, I would look at the balance sheet. I wouldn't go by the stock. I wouldn't go by the stock price. But if that was a condition, if that was something I was looking at, I would see the PE ratio. Higher the PE ratio, the better, because if the market is expecting the company to do well, I'll go with the market in their assessment. Why would high PE ratio exist in the first place? Yeah. So that means companies expected to generate revenues in the future, right? If I'm buyer, I would like to pay as, for example, Apple. I'll jump on Apple today. You know, if it's 29, I would think twice. If it's 13.5, I'll probably say yes. But is it good for the shareholder today? No. Because last year Apple's PE ratio was 29. Today Apple's PE ratio is 13.5. So it's lost that market expectation of the future revenue generation. And that means the valuation has come down. For example, if a building is valued at $1 million last year, and today it's valued at $500,000. It's good for the buyer, but it's not good for the seller. So let's look at industry ratios. Banking, 1.32, software, 6.14. So you can see that traditionally, you know, these new sector companies are very hard to value. Drug, for example, Pfizer is 5.87, electronic utility is 10.14, semiconductor, Intel Corporation 4.0, steel 0.33, tobacco 1.30, S&P 500 14.22. Market-based ratios. Cash flow per share. So you have cash flow per share that includes net income plus depreciation. Why depreciation? Because this is an expense that the company is not paying to anyone. Rather, it's cash coming back into the company. So this is adding to the cash flow. So it'll be 253.6 plus the depreciation. Where is depreciation number going to come from? Income statement. Net income is going to come from income statement. Shares outstanding is other information, and that's 250. So 253.6 plus 120 divided by 250 is 1.49. That's cash flow per share. Again, higher the number, the better, because you want to have as much of cash flow as possible. Price per cash flow, which is an alternate to price earnings. In this case, it's 8.2. Again, you know, it's same debate from whose perspective. But in this case, you would want to have a high cash flow anyway, you know. Even if you're a buyer, you want to have a higher cash flow because you want to have a safe company. If it's a low cash flow, anyway, it should be discounted. So this is a little tricky. Do you all see this? Would you feel safe having a company with high cash flow or low cash flow? High. So in this case, even if you're a buyer, you would tend to pay a little higher number here because of the denominator. If the denominator goes up and price also is up, then price plus cash flow, price divided by cash flow will be up. But if the price remains consistent, cash flow goes up, it'll come down. So you'll have to look at, how it's impacting the share price. Because like in the case of Facebook, I would suspect that this price divided by cash flow would be a higher number. Why? Because the rate at which the price per share is going up would be higher than the cash flow per share. So it may need some deeper understanding and analysis here. Book versus market value, this is, again, we have discussed this concept and it's important to understand. For example, the market-based ratio, you have a book value per share, and this will give you an understanding of how much a premium you're actually paying for a stock. If your car is valued at $5,000, but somebody is willing to pay you $7,000 for it, so somebody's paying you $2,000 extra premium for it, and this will give you what that premium, value can be by looking at what the book value per share is and what the market value per share is. So book value per share will come from common equity divided by shares outstanding. Common equity will come from the balance sheet side, right-hand side, and shares outstanding we've already calculated. It's already available, 250,000 shares. So that's equal to 7.91. Now, market to book ratio is market value per share, which is 12.17. And book value per share is 7.91, which is equal to 1.54. So the market value of the company is 1.54 times its book value, which is good for the shareholders, because it's selling at a premium, right? By the way, what is the total market capitalization of this company? What is the market value of this company? Total market value of this company? $12.17 times 250,000. That's the market value, total market value of the company. The formula is shares outstanding multiplied with the price of each share. That will give you the total market capitalization. What is the book value of the company? Yeah, the answer is here. The answer is here. That's a book value. And the market value was what, 3 million? 3 something. So you can see the difference. Where is that additional, where is the difference coming from? It's coming from the expectation of the future cash flows. So this is the wealth that the managers have been able to generate for its shareholders. So you see that on book, the company is valued at 1.9 million approximately, and in market it's valued at 3 million. So that extra, that difference is coming from the manager's works. They have been able to generate that extra wealth for the shareholders. So managers should be rewarded. A little bonus. So PE ratio, price earning, how much investors will pay for $1 of earning, higher is better. We've discussed this. Again, whose perspective? Buyer is different. MB, how much paid for $1 of book value, higher is better. PE and MB are high if ROE is high, risk is low. So again, comparison here. It seemed to underperform from industry average because industry average is 14.2, here is 12. Price divided by cash flow is better, and market to book value is lower. So managers should work a little bit more, to create additional wealth. So let's look at some of the other ways to compare analysis, and this is by common size balance sheet, divide all items by total assets. So in this case, what's happening is so these are the percentage for each line item. And I can show you an example. It will take me a little while to just copy the okay, what I'm trying to do is open up Excel. It'll be much faster to demo this. So if I make a mistake, just correct me, and I'll share with you students online. Just give me a minute. Okay, this is correct. So what I'm going to do is I'm going to share Okay, students online, can you view the Excel worksheet here? So the way it works is pretty simple. I mean, the total is going to be 100%. So each line item would be a component of the total asset. So I'm going to anchor this value . And this will total up to 100%. No, one mistake. One mistake is this. Because if I'm taking every line item, then I cannot add, because this will be double dipping. So even though if I take this, I'll have to remove that effect. So this is going to be total less the total fixed asset. Now it's 100%. So you can see that now I can compare which component in percentage terms accounts for, you know, how much of value. Okay, students online, is it clear? I think it's pretty straightforward. So let's go back. So you can see that this is what I recreated, and this part here, this is what I recreated, you know. So cash is basically how you interpret these numbers. Cash is 3% of the total asset. I'm sorry, 0.3%. Short-term investment is 0.3%. Accounts receivable is for 22.4%. Inventories are 41%. So you definitely know that you have to get rid of your inventory levels. You know, those are pretty high. Total current assets are 64%, and then total assets, net fixed assets are 35%, and you can compare them over the years, you know, what the numbers are like. So I did for industry. You can try and do it for this company, you know, as an example if you want to do. Same thing for the liabilities and equity. Again, divide all items by total liabilities and equity. So that's one way to do it. Analysis of common size balance sheets. Computron has higher proportion of inventory and current assets than industry. Computron now has more equity, which means less debt than industry. Computron has more short-term debt than industry, but less long-term debt than industry. So let's go back and see. I'm going to clear this. So let's say this company's name is Computron, and we're comparing. Let's compare 2011 estimate to industry. Cash is marginally higher. Short-term investments are again a little bit higher. Accounts receivables are about the same. Inventory are higher. So obviously, compared to industry, they are about 7.6% higher than industry, which they need to get rid. And net fixed assets are lower than industry average, which may or may not be good, because, you know, if you want to have your own product lineup, that way you should have your own horizontal manufacturing, you know, so that you can control quality. But in this case, they seem to have less total fixed assets. In terms of liability side, notes payable are higher. Accruals are marginally, accounts payable are marginally lower. Total current liabilities are higher, definitely. Long-term debt is lower, which is good. And total equity is higher than industry. So this is how you will analyze, you know. And that's what basically is what is being analyzed here. Another way to do it is common size income statement. Divide all items by sales. In this case, the same calculation can be done by taking the total sales number. Now sales is 100%, and then other items are compared against sales. So you can see that main item obviously will be cost of goods sold. And Computron has about the same cost of goods sold percentage number than industry average, which is fine. Other expenses are higher, so maybe they can control the other expenses because they are 5.5% higher than industry. Depreciation is lower because of the fact that Computron had lower fixed assets, so they will have lower depreciation compared to industry average. So you can see, you know, from the previous one. Look at this net fixed asset. Industry average is 35.9. They have 23.8. That's why there is lower depreciation. Earnings before interest and taxes 6.1, which is lower than industry. Interest expense is higher. EBIT is lower. Taxes are lower. And the final number 2.6, which is lower than industry. So they probably have to figure out a way to lower down their other expenses, in this case, because other items are pretty much about the same as industry. So Computron has lower cost of goods sold than industry, but higher other expenses, as we had identified. Result is that Computron has similar EBIT as industry. So any benefit that the Computron had in cost of goods sold is lost because of other expenses. So maybe they have higher salaries being paid or other expenses, advertising and those kind of things. Percentage change analysis, percentage change from year to year. So now this is year to year. You can change the numbers from year to year. So the base year is 2009. That's why it's 0% here. And change from 9 to 10 is 70%. From 10 to 11 is 105%. How do you do that? You can look at the comparison numbers. So let me show you an example, and then I think you'll figure out how to do. Let's go to the income statement. So the sales number in 2010 is 5,834,400, and in 11 is expected to be 7,035,600. So if you can get your Excel or calculator open, you can simply just take 7,035,600 divided by 5,834,400, and that's 20.5%. 1 is the 100. That's 20.5. Okay, so let's go back. Okay, so I think let me see what they have done. This is going to be this minus that's 20%. So something is wrong here, because we got a sales number of 5.8 million in 2010, and then there's a sales number of 7 million in 2011, and that's not 5% increase. 5% increase would have been 6.126 million. That would have been 5% increase. Or 105 is 6.44 million. So this number is wrong, because if you take the data that's given to us and you can calculate, that's the sales number for 2010. This is the sales number for 2011. You can work out any way you want. I mean, this is not going to be 5% increase between 2010 and 11. So let's go back. But anyway, what you're doing here is comparing from year to year. So again, same thing you can do for the cost of goods sold, which is going to be this year's cost of goods sold divided by last year's cost of goods sold. That's going to give you the percentage change. Or you can just take it this year minus last year divided by last year. Either way, it's going to give you the same number. Other expenses has reduced from year to year. So main thing to understand here is how to interpret these numbers. In this case, your sales has increased by 5 from last year, and that's good. Cost of goods sold has gone up by 2%, 2.5, which is probably a little not so good, but compared to the increase in sale, it's justifiable. Other expenses have reduced or expected to reduce, which is good. And your depreciation has changed. EBIT has gone into positive territory, which is good. Interest expense has reduced, which is good. EBT has increased, which is good. And net income is increasing in positive territory, which is good. So we see that 2011 sales grew by 105% from 2009, and the net income grew by 188% from 2009, so Computron has become more profitable. Percentage change balance from on asset side, you can now look at the asset and then change from year to year. Again, take the base year, which is 2009. I think why we are not getting the right answer here is it's not from this year to this year. They probably are taking the 9 base year and then basing it these changes from year to year. Yes. So we don't know because these numbers were not given to us. Yes. It's just a given. And we are trying to calculate it, but actually it's just given, because we can sit here all night, but we will not get those numbers. So same thing, we can just analyze this. Analysis of percentage change balance sheet, we see that total assets grew at a rate of 139%, but remember this is going to be with respect to the base year, okay? So asset utilization remains a problem, which we had identified. DuPont analysis is just an enhanced ratio analysis, which is adding ratios from 3 sources and giving a number, which is coming from the expense control, profit margin, then asset utilization, which is total asset turnover, and debt utilization, which is the equity, management. So it shows that how these factors combine to determine ROE. By the way, DuPont, is that chemical company. So this was sort of an internal assessment measure. If you want, you can read through it. And they came up with this analysis, which was copied over by other industry because it gives you a neat sort of a ratio to assess your ROE, which is return on equity. So it's coming from the profit margin, which is sales divided net income divided by sales, total asset turnover, which is sales divided by total assets, and equity multiplier, which is total assets divided by the CE. And if you were to simply see, you can cancel out sales with sales here. Total assets will cancel out from here. So net income divided by CE will be return on equity simply. So, I mean, if you had to do it, there is a derivation for it, but if you were given the numbers, for example, in this case, we are given numbers. So, for example, if the ratio here is 2.6, this one is 2.3, and this is 2.2. So, ROE is 13.2. In 2008, 2009, it's negative 16.6. 2010 is 13%, and industry is 18%. Obviously, return on equity is lower in all the years compared to industry. Comparison with industry average is difficult if firm operates many different divisions. Seasonal factors can distort ratios. Companies which have seasonal sales, for example, energy companies or textile companies which are engaged in sales of woolens and like North Face or those kind of companies, they will sell more in winters. In that case, ratios would be better in the quarters of latter year and the early half of the year, and that has to be taken into account. Window dressing techniques can make statements and ratio look better. Again, this is inherent weakness for any statistical analysis, that you can somehow make it look good. Different accounting and operating practices can distort companies. For example, in different countries you have different accounting principles, so that can distort numbers. So qualitative factors, there is a greater risk if revenue tied to a single customer. That's obviously a risk. We have seen that in recent financial crisis. GM, when it filed for bankruptcy, a lot of smaller companies which were 100% tied to GM, they also had to shut their operations. Revenue tied to a single product. BlackBerry, we discussed that. They had just one product that they were focused on. Reliance on a single supplier. Toyota cars, if you recall, were held in manufacturing because their paint supplier was in Japan, which was close to the place where they had tsunami, the nuclear power plant. And for several months, Toyota had problems supplying cars because they had only a single supplier of paint. High percentage of businesses generated overseas, and like oil producing companies, oil companies and gas, oil and gas. I mean, their major supplier may be in Middle East, and whenever there's problem in Middle East, companies tend to have problems because they don't know if there'll be some political situation. So what is competitive situation? What products are in pipeline? What are the legal and regulatory issues? They all impact a company's overall performance. So ratios are just indicative. They'll give you numbers. How you analyze them is going to be important. And that brings us to end of rather short chapter, 54 slides.